Today I'm going to talk about something central to how Upleft builds client portfolios, and that is the concept of diversification. At its very basic level, this is the idea that you don't want to put all of your eggs in one basket. For instance, if you owned an entire portfolio built of one stock and that company had a bad run or a bad quarter, you might see your personal wealth take a pretty deep dive, all based on one management team or one bad lawsuit or one production failure. And this is more risk than most of our clients are willing to accept. So for that reason, most investors look to diversify. Now, the definition of diversification, depending on who you ask, could go from anything to owning 4 or 5 different stocks to perhaps being in different asset classes like stocks and bonds and cash, maybe some real estate. But again, we've got a different notion of what it means to be properly diversified. For that reason, I'm going to walk you through this quick demonstration. Let's say, as a client, you're somewhere along this efficient frontier where the color green represents bond exposure and the color blue represents equity or stock exposure. That said, you're more risky on the upper right-hand side of this chart and less risky on the lower left-hand side of this chart. In this case, risk is being measured by a standard deviation. If you're a client who's somewhere in the middle here, let's take a look at, for example, this 40% stock, 60% bond portfolio indicated by the yellow arrow. Some advisors might go out and buy a balanced fund, which is to say they'll find one mutual fund with a company that they have chosen, that inside that fund, they've got stock managers, they've got bond managers, and they put together this portfolio for you at this diversification split. That said, an advisor who's looking to do a little more work perhaps, or perhaps thinks like we do, that the best stock manager might not be the best bond manager, they might go out and buy 2 mutual funds. They might buy a stock fund with 40% of your assets and a bond fund with the other 60% of your assets. We still don't quite think that's enough, because when we look at the worlds of stocks and bonds, we say there's a different skill set involved in picking US stocks, for instance, versus international stocks. We don't necessarily expect a person who has the knowledge and skills to pick a good company, let's say in Germany, to be able to also pick a good company in Arizona. Bonds are similar, but in some ways even a bit more complex, because in the bond world, one might have to consider different details about government finances, currency exchanges, global economics, and so forth. Now, if we take just the US stock portion of this example portfolio, we'll say, well, not all US stocks are created equal either. A person who's able to track very, very large companies and tell you what makes a good company and what makes a bad company might have a different skill set than someone who tracks very small companies. There may be different indicators you look for, different measurements of the management team, different numbers that are important on a quarter-to-quarter basis to judge the success of a small company versus a very, very large company. It's easy to see now how a portfolio that went from potentially one manager in a balanced fund has gone to perhaps 5 or 6. Well, if we look at just the large cap example, there are different styles of investing that work better in different times. In this very simple example, we'll break it down to just value and growth. Now, a large value manager is going to look for companies that were seen to be at a certain value, and then because of bad time period or misfortune or what have you, are being undervalued to their perception today. They'll buy that stock hoping that when it gets back to what they think the reasonable value is, then you'll be able to benefit from those gains. A large growth manager, for instance, is looking for a company that may be fairly valued today, but they're looking down the road saying this company is going to grow into something more valuable. And that's where an investor will get the growth of their dollars. But even inside things like value and growth, there are several sub-styles, so to speak, that might bring value to a client portfolio. I feel like I've gotten enough in the weeds already without getting into these individual styles, but for this example, let's say there's 5 different types of large value management that might make sense in some combination for a diversified portfolio. Now, if any style of large value underperforms, it won't hurt your portfolio that much. We're going back to making sure your eggs are spread across several baskets here. Similar for growth, similar for small cap, and this is just in the US space, don't forget. Now, if we were to expand this concept to all of these other asset classes, we have multiple managers, multiple styles, different sub-asset classes inside stocks, inside bonds, inside international stocks, inside international bonds. You might even notice that inside the international sections, if you follow my pointer here, we've got both developed international countries. These are like England and Canada, for instance, versus emerging markets, some more frontier countries, like some of the countries of Eastern Europe, Asia, Africa, with less developed international markets. And similarly, we have that same distinction made in the international bond space. Now, by following this logic, and for going after what we think is the most responsible way to look at diversification of a portfolio, you can see how one account for one of our clients might have, in this example, 10 distinct asset classes across this red line. And under those 10 distinct asset classes, you might have 50 different disciplines and 50 different managers. Now, that's to make sure that every individual box on this chart is managed by who our research says is today's best specific manager for that sub-asset class and for that specific style. Again, all to go into one client portfolio. Our lawyers would like you to take a look at this disclaimer, indicating that this presentation was not meant to be specific advice for any client, but really just an example of what our portfolios might look like. Thank you very much for your time and attention. I look forward to teaching you more on the next presentation.